everyone, and welcome to the Latinx Business Podcast. I'm your host, Randy Gomez, and if you're looking to demystify the world of business through the raw, authentic stories of Latinx entrepreneurs, you've come to the right place. As someone with an MBA and an IRS enrolled agent license, I spent years helping freelancers, partnerships, and S corporations navigate the often tricky waters of the U.S. tax law. Now, I'm bringing that expertise and passion to this community right here. So thank you for tuning in, and you know what? It's time to talk business. Hey guys, welcome back to another episode of Latinx Business Podcast, Tax Tip Edition. And thank you today for joining. I know your time is extremely valuable, so I really appreciate you guys listening to the show. And today I want to talk about Schedule A itemized deductions and what you can deduct if you're able to deduct stuff. Now, not everyone can deduct stuff. First and foremost, we should discuss standard deduction and Schedule A deductions, which are itemized deductions. You can take a standard deduction, no questions asked. Everyone in America gets that, whether you're single or married. Now, for 2025, that goes up to $15,000. That $15,000 you make that you don't get taxed on, which is a good deduction on your federal return. Now, you can deduct more than $15,000, but usually you need to be a homeowner or pay a lot of state taxes on your W-2, and then you will be able to itemize. You want to itemize means that you're going to deduct more than $15,000. So it's one or the other. You can't take both deductions, right? So you can't take the $15,000 then itemize some more, like receipts and stuff, medical and stuff like that. $15,000, no questions asked. You still get that deduction. Let's say you have $18,000 in mortgage interest, and then you have property tax of another $8,000. Now you're well over that $15,000. You want to itemize because you have surpassed that $15,000 threshold, right? Now you're gonna deduct a lot more. So you want to not pay taxes on $20,000, $25,000, $30,000, $40,000, right, of your taxable income. So that's how that works. Standard deduction or you itemize. One or the other, can't take both. Okay, now let's move into Schedule A and what deductions you can take if you are in that bracket where you can take itemized deductions. So Schedule A, the first thing that's on there is medical and dental expenses. So medical and dental expenses, this is a very high hurdle to pass. Not that many people can take deductions. Unfortunately, who I see people take this deduction are the ones that have very high bills and medical bills, or have like a lot of people in their family that are sick and they are dependents of that one person that works, and there's just a lot of bills that they're paying for that year. There's a minimum amount, so it has to be at least 7.5% of your adjusted gross income, right? So let's say you make $100,000, you at least have to pay 7.5% of $100,000, which is $7,000. Right? Over $7,000 of medical bills, then you can start using that deduction to itemize, right? So you have to have 10 or 15,000. I mean, you can have 8,000, but you're only going to be able to use like 500 of it, right? It's not that much. So it's a high hurdle to pass. It's hard for people to take medical expenses. But any given year, people can land in a situation where their income's super low and they have high medical bills, even if it's $5,000, $6,000, $7,000, $8,000 one year, and they're able to utilize that, right? It's unfortunate because that year is maybe a year that they can't work because of their medical situation, but in terms of taxes, it kind of works out for them. Some of the examples that they can deduct: so payments for diagnosis, for cure, for mitigation, treatment, preventative disease, medicines, prescribed medicines, insulin, medical and dental insurance, medical devices, travel costs for medical care, mileage, for your dependents as well. If it's for like your parent, but they're not your dependent, you can't deduct it. So they have to be your dependent on your tax return in order for you to be able to deduct it. Same goes for like surrogacies. If you're paying for surrogacy for someone to carry your baby, they need to be a dependent on your tax return, or else you can't deduct the expenses for them. Really unfortunate, but I know those expenses are high. So 100%, if you're going to take a medical expense, it has to be for someone that's a dependent of yours or yourself on that return. Taxes you pay. So you pay either local taxes or you pay property taxes, real estate taxes, right? So there is a cap. Thankfully, it went back. So there was never a cap before, and Trump changed the tax laws, the first overhaul. Now it went down to 10,000. So that really affected California and like also coastal cities like New York, because state real estate taxes are really high in our states. Well, a lot of people lost deductions that they could take because of the change. But now with the OBBA change again, which again Trump introduced again, it's gone up from 10,000 to 40,000. So that's going to mitigate a lot of people losing that deduction in the real estate taxes they pay, because that's a lot of real estate taxes that people pay, especially in states like California and New York, right? The coastal states. So yeah, that's great because it's gone up to 40,000. With taxes paid, that also includes taxes paid on your W-2. So W-2 plus your property taxes, you can get up to 20, 30, or 25,000, right? It just depends how much you pay on your W-2. So that could be a sizable deduction for any individual. That's why earlier I said you could get to itemizing just based on how much taxes you pay, right? All right, so that also includes like your D&B fees for your property, because that's a tax you pay, and interest you pay on your home mortgage, right? So this one hasn't changed for I think probably over a decade. It's remained the same. If you have a loan for your home mortgage, a loan on your home, if it's over 750, you can't take any interest over 750. So your tax guy, like myself, has to make an adjustment on your tax return. So if your loan is $1 million, to interest on 250,000, you cannot take that interest as a deduction. But interest you pay 1,000 of that loan, you can take as a deduction. We run the calculations here. That's why you guys pay us to do that for you, right? So and make sure that your accountant or your tax guy or woman is doing that, because you really want to make sure that, hey, you don't get audited and you're like, hey, I didn't know that I can take that deduction. I got a 1.5 million home. Well, half of your deduction is not allowable, unfortunately, half of your mortgage interest that you take. But 750 is still allowable, especially with the high interest rates right now, right? Okay. Gifts to charity. So there's two ways you can do gifts to charity. You can do cash. So any cash that you donate, whether it's cash, check, or credit card, that organization is going to give you a donation receipt for the value amount of what you donated. And as long as you didn't receive any goods or services in return, you can take that full deduction of that amount, whether it's $100, 200, 300, whatever. If you pay for like a plate of food at a donation gala or something like that, you're supposed to subtract out the value of the food, and let's say the ticket is $150, the food costs $25 or $50, then truly your donation is only $100 if the plate was $50 to attend, right? The other way to donate stuff is if you donate Goodwill stuff, household items, your car, or stock. You can also donate your stock or digital assets, but you want to get all of that appraised. You want to get appraised by, you want to have documentation of what things cost, when you bought it, when it was donated to you, or when you donated it to the organization, and at what price, because you get the fair market value of that, right? So if I donate Apple stock that I bought 20 years ago, let's say I bought the Apple stock at $5. Now Apple stock is worth $1,000. You donate $1,000 to that nonprofit because that nonprofit gets to step up in basis. They can sell it for $1,000. That nonprofit now has $1,000 they can use to run their organization. So you get a $1,000 deduction on your tax return, right? Which I think is a great thing. There are other limitations, but we won't really get into those when like your adjusted gross income is like 60%, 30% for certain non-cash gifts. But I'm just going to say most people don't fall under those. So we're not going to really concentrate our efforts here on that today. Okay, casualty and theft losses. Yeah, so casualty and theft losses are only deductible if they are attributable to an event in an area declared as a federally declared disaster area, right? So the president declares those areas, right? So your area, you can take a deduction for that only if it's declared by the president. Okay, so this is a really popular one, believe it or not. So 2% itemized deductions. What does that mean? Gambling losses or impairment related to work expenses of a disabled employee. Gambling losses, people gamble in the state of California, a bunch of states in the US. So if you make $100,000, you can take a deduction up to $100,000. However, you probably gambled $150,000, $200,000, $300,000 to make that $100,000. So there's you're not really winning here, right? The casinos are making more money off of you. However, you don't pay any taxes on that. But you do want to make sure that you take that deduction. Talk to your tax guy, because a lot of people don't know about that. Impairment related work expenses of a disabled employee. So if there's any items that you need to buy if you're a disabled employee to make your work easier, you can put that as a write-off as well. And then I guess just to end the episode today, most people take the standard deduction, right? Most people and people don't have like massive tax bills that they pay under W-2s or home property, their vehicle properties and stuff like that. So they don't reach the 15,750 threshold, at least for 2025. Yeah, I just, and if you're married, you get twice as much, right? Because each individual gets their own. So that would be around 31,500 you don't pay taxes on. But again, itemizing is great. Not everyone is able to do it, but if you are, talk to your tax guy, and then we will be able to get you the best write-offs and guide you through it, really, right? That's why you're coming to us. So again, thanks for joining another tax tip episode. My name is Randy Gomez, and here at RG Taxes, we offer an initial consultation. It is at a fee. Again, we review your returns, last year's, current year, and your tax documents and see if there what improvements we can make. And then it's at no obligation, so you can become our client or not, but we do our best at answering all your questions. So it's really to inform you and to make you a better tax preparer so you make more informed decisions, but also so you're aware and you're educated, right? So our system has become so complex that you need to be educated. So if you're paying for education, it's a good thing. And again, it's at no obligation. So I think it's a win-win situation. And if you do decide to become our client, we will apply that initial consultation fee over to your first payment for tax preparation. Thanks for joining, and we'll see you at the next episode. Thank you so much for joining me on this episode. Please take a moment to subscribe, rate, and share this podcast with your network. Your support helps our Latinx business community grow stronger with every listen, and I truly invite you to connect with us. Send us your questions, your comments, or even your own business stories to randy@rgtaxes.com. I would love to hear from you. Until next time, keep learning, keep building your business, and keep growing your business mindset.